If your combined income is just $1 over $25,000 as a single retiree, up to 50% of your Social Security benefits can become taxable. If it rises above $34,000, up to 85% of those benefits may be taxed. For married couples filing jointly, taxation can begin once combined income crosses $32,000, and it increases again at $44,000. Now here is where this becomes serious. If you receive a lump sum Social Security back payment of $10,000, $15,000, even $20,000 in a single year, that one payment can push you across those lines. And once you cross them, the system responds automatically. A new bill could eliminate federal taxes on certain Social Security back payments, but it is not law yet. So the real question is not whether Congress may act. The real question is this: are you already close to one of these income lines without realizing it? Now, before we go any further, let me ask you something. Have you noticed how quickly these rules and thresholds are shifting this year? One letter, one adjustment, one small income change, and suddenly the numbers look different. If you want clear explanations before those changes affect you, make sure you are subscribed and notifications are turned on. I cover these updates calmly and early, so you are not reacting after the fact. A missed update is not just information, it is money. My name is Judith Carver. I am a senior protection educator. I am not a lawyer, and this content is for educational purposes only. Laws and tax rules can change, and your situation is unique. Let us begin with the current reality. Under existing federal tax rules, Social Security benefits are not automatically tax-free. Whether they are taxed depends on what is called combined income. Combined income generally includes your adjusted gross income, any non-taxable interest, and 1/2 of your Social Security benefits. When that number crosses certain thresholds, a portion of your Social Security becomes taxable. For individuals, once combined income exceeds $25,000, up to 50% of benefits may become taxable. Once it exceeds $34,000, up to 85% may be taxable. For married couples filing jointly, the first threshold is $32,000. The higher threshold is $44,000. Above that, up to 85% of benefits can be included in taxable income. Here is the part that shocks many retirees. These thresholds have not been meaningfully adjusted for inflation in decades. That means more and more retirees cross them simply because other income has increased over time. Now here is where timing becomes dangerous. Suppose you applied for retirement or disability benefits and your claim was delayed. Months pass, maybe even years. Eventually, you receive a lump sum payment covering prior periods. That payment represents money you should have received earlier, but the IRS sees it in the year it is paid. Pause for a moment. On paper, it looks like you suddenly earned significantly more income that year. The brutal truth is that this one-time payment can push your combined income from, say, $28,000 to $40,000. That shift can move you from the 50% taxable range to the 85% taxable range. You did not suddenly become wealthier. You received delayed benefits. But the tax system responds to totals, not timing explanations. This is where it gets even more serious. Higher reported income in one year can affect more than just your federal tax bill. It can affect Medicare premiums. For 2026, Medicare Part B premium increases begin once modified. Adjusted gross income exceeds approximately $103,000 for individuals and approximately $206,000 for married couples filing jointly. Now, you may think that sounds high, but consider this. A retiree taking required minimum distributions, selling investments, or receiving a large lump sum Social Security payment could move closer to that bracket faster than expected. And Medicare premiums are based on income from 2 years prior. That means a lump sum received today could raise your Medicare premiums 2 years from now. Most people never see that connection until the premium notice arrives. Let me show you how this unfolds. Eleanor receives a retroactive Social Security payment covering 2 prior years. The lump sum is $12,000. Her regular combined income is around $30,000. That year, her combined income jumps to $42,000. 85% of her Social Security becomes taxable. Her federal tax bill rises. 2 years later, her Medicare premium increases because her prior year income was higher. She did not see this chain reaction coming. This is the part nobody talks about. The system does not ask whether the money represents past years. It looks at the total reported in the year received. Now enter this proposed bill. The legislation under discussion would eliminate federal income tax on certain Social Security back pay or restored benefits. In simple terms, it aims to prevent retirees from being penalized tax-wise for receiving delayed payments in a single year. Stay with me. This bill is not yet law. It is under consideration. That distinction matters. But the fact that it is being discussed tells us something important. Lawmakers recognize that current tax treatment can create unintended financial pressure for retirees. Here is where it gets interesting. Under current rules, there is already a provision that allows certain retirees to allocate lump sum Social Security payments to prior years for tax calculation purposes. This is sometimes referred to as a lump sum election. But the calculation is complex. It requires reviewing prior year tax returns and recalculating hypothetical tax as if the benefits had been received in those earlier years. Many retirees do not know this option exists. Others find it confusing and skip it. The untold truth is that confusion can lead to overpayment. If someone does not apply the special calculation correctly, they may pay more tax than necessary. The proposed bill seeks to simplify this by removing federal tax on qualifying back payments entirely. That could eliminate complicated recalculations and reduce the risk of crossing those $25,000, $34,000, $32,000, or $44,000 lines in a single year. But we must remain grounded. Proposed legislation can change. It can be narrowed. It can be delayed. It can fail. Until it becomes law, current thresholds apply. Here's a gentle reality check. If you are expecting a retroactive Social Security payment or have recently received one, review how it will be reported under existing law. Do not assume Congress will change the rules in time to help you. Let us also address another layer. Retirement income is rarely simple. You may have Social Security, pension income, required minimum distributions, interest, dividends, or capital gains. Each of these adds to adjusted gross income. Add a lump sum Social Security payment, and you may cross a taxation line faster than expected. Watch out for this. Even if the proposed bill eliminates tax on certain back payments, regular ongoing Social Security benefits would still be subject to the current combined income thresholds. Understanding which payments qualify would be essential. This is where it becomes strategic. If you receive a large lump sum Social Security payment, consider consulting a tax professional before filing. There may be ways under current law to reduce the impact. Planning ahead can also help you anticipate possible Medicare premium adjustments. Now, let me give you another example. A retired couple receives restored benefits after a successful appeal. The lump sum is $18,000. Their normal combined income is $40,000. That year, their combined income rises to $58,000. They move deeper into the 85% taxable range. The following year, they are surprised by a higher tax bill and concerned about future premium adjustments. They assumed Social Security was mostly tax-free. They did not realize timing could change everything. Most retirees think of Social Security, federal taxes, and Medicare as separate systems. They are not. They are interconnected through income reporting. This bill highlights a broader theme. Timing of income matters, reporting matters, documentation matters. Even if the legislation does not pass, awareness alone can prevent costly surprises. Ask yourself honestly, have you received retroactive Social Security payments? Are you expecting restored benefits? Did your income spike unexpectedly in a single year? If so, review your combined income against those $25,000, $34,000, $32,000, and $44,000 lines. Do not assume the system adjusts in your favor. It responds to numbers. Let us summarize calmly. A new bill under consideration could eliminate federal taxes on certain Social Security back pay. If passed, it may reduce tax burden for retirees receiving lump sum payments and potentially prevent downstream premium increases tied to income spikes. But it is not law yet. Current thresholds still apply. If you found this explanation helpful, like this video and subscribe so you stay informed about Social Security, Medicare, tax rules, and retirement protections before they affect you. Share this with someone who recently received a lump sum benefit and may not realize how it could affect their taxes. If your situation feels legally or financially complex, contact a licensed attorney or qualified tax professional who can review your specific circumstances. You deserve clarity, not confusion. Carry this forward with confidence. Your rights do not expire with age.